Required minimum distributions, RMDs, are a crucial concept in retirement planning, particularly in the United States. They represent the minimum amount that must be withdrawn annually from certain tax-advantaged retirement accounts once an individual reaches a specific age. While RMDs ensure that tax-deferred savings are eventually taxed, they also have broader implications for financial planning, taxes, and retirement income. This video will explore what RMDs are, their pros and cons, and their impact on taxes, providing a comprehensive understanding of this important financial requirement. What is an RMD? An RMD, or required minimum distribution, is the minimum amount that must be withdrawn from a retirement account each year once the account holder reaches a certain age. The purpose of RMDs is to ensure that individuals eventually pay taxes on the funds in their tax-deferred retirement accounts. These accounts include traditional IRAs, 401(k)s, 403(b)s, and other similar retirement savings vehicles. The age at which RMDs must begin has changed over time, with recent legislation increasing the starting age to 73 as of 2024. It was previously 72. The amount of the RMD is determined based on the account holder's age, life expectancy, and the balance in the retirement account at the end of the previous year. The IRS provides life expectancy tables that are used to calculate the RMD amount. For example, if an individual is 75 years old with a retirement account balance of $500,000, and their life expectancy factor is 22.9, according to IRS tables, their RMD for the year would be approximately $21,834. Pros of RMDs. 1. Ensures tax revenue. One of the primary benefits of RMDs from the government's perspective is that they ensure tax-deferred funds are eventually taxed. Retirement accounts like traditional IRAs and 401(k)s allow individuals to defer taxes on contributions and investment earnings, but RMDs mandate that these funds are withdrawn and taxed, providing a steady stream of tax revenue. 2. Discourages excessive hoarding. RMDs encourage retirees to use their savings rather than hoard them indefinitely. This ensures that retirement savings fulfill their intended purpose, providing income during retirement. By requiring distributions, RMDs help prevent retirees from overly conserving their funds and potentially neglecting their quality of life. 3. Provides predictable income. For retirees, RMDs provide a predictable source of income. Knowing that a certain amount must be withdrawn each year can aid in budgeting and financial planning. This predictability can be particularly beneficial in creating a stable retirement income strategy. 4. Incentivizes spending. Since RMDs are mandatory, they can encourage spending during retirement, which can stimulate the economy. Retirees may use their RMDs to cover living expenses, healthcare costs, travel, or even gifts to family members, all of which contribute to economic activity. Cons of RMDs. 1. Tax impact. One of the most significant drawbacks of RMDs is their impact on taxes. Since RMDs are considered taxable income, they can push retirees into higher tax brackets, increasing their overall tax liability. This can be particularly burdensome for individuals who do not need the income from RMDs and would prefer to leave their funds invested. 2. Potential for penalties. Failing to take an RMD or taking less than the required amount can result in severe penalties. The IRS imposes a 50% excise tax on the amount that was not withdrawn, which can be a substantial financial hit. While recent changes have reduced the penalty to 25% and potentially as low as 10% if corrected in a timely manner, it remains a significant concern. 3. Reduced investment growth. As RMDs require funds to be withdrawn from retirement accounts, the remaining balance in the account is reduced, limiting its potential for continued tax-deferred growth. This can be a disadvantage for retirees who are in good health and expect to live for many more years, as it may deplete their savings faster than anticipated. 4. Complexity in planning. Calculating RMDs and integrating them into a comprehensive financial plan can be complex. The amount of the RMD changes each year based on the account balance and life expectancy, requiring ongoing attention and adjustments to retirement plans. This complexity can be challenging for individuals who are not financially savvy or do not have professional financial advice. Impact on taxes. The impact of RMDs on taxes is a critical consideration for retirees. Since RMDs are taxed as ordinary income, they can significantly affect an individual's tax situation. Depending on the size of the RMD, it may push the retiree into a higher tax bracket, increasing their marginal tax rate. This, in turn, can reduce the net income available after taxes and potentially trigger additional taxes on Social Security benefits or Medicare surcharges. Tax bracket considerations. For retirees with substantial retirement savings, RMDs can result in a spike in taxable income, pushing them into higher tax brackets. For example, if a retiree has $100,000 in other income and is required to take a $50,000 RMD, their taxable income would increase to $150,000, possibly moving them into a higher bracket. Impact on Social Security and Medicare. RMDs can also affect the taxation of Social Security benefits. If a retiree's combined income, including RMDs, exceeds certain thresholds, up to 85% of their Social Security benefits may become taxable. Additionally, higher income from RMDs can lead to increased Medicare Part B and Part D premiums due to the Income-Related Monthly Adjustment Amount, IRMA. Strategies to mitigate tax impact. To manage the tax impact of RMDs, retirees may consider strategies such as Roth conversions, which involve converting a portion of tax-deferred retirement funds to a Roth IRA, where future withdrawals are tax-free. By doing so, they can reduce the size of their traditional retirement accounts and, consequently, their future RMDs. Another strategy is to withdraw more than the required minimum before reaching the RMD age, spreading the tax burden over several years and potentially keeping income in a lower tax bracket. Conclusion. Required minimum distributions, RMDs, are a fundamental aspect of retirement planning in the United States, with significant implications for both retirees and the government. While RMDs ensure that tax-deferred savings are eventually taxed and provide retirees with a predictable income stream, they also present challenges, particularly concerning taxes and financial planning complexity. Understanding the pros and cons of RMDs, as well as their impact on taxes, is essential for retirees seeking to optimize their retirement income and minimize their tax burden. By carefully planning for RMDs and considering strategies to mitigate their impact, retirees can better navigate this aspect of retirement and achieve their financial goals. Thanks for watching. Please subscribe.